Thank you for joining and welcome to this session on BB Healthcare. We're joined by Paul Major, who has been the manager of the trust since the launch of it in 2016. He and his colleague Brett have run the trust in the same concentrated manner since then, and the trust announced its interim results on Monday, which highlighted that they'd so far notched up a very strong performance since launch, delivering a share price total return to the 30th of November last year of 97.6% against 64.3% for the benchmark index. And that strong performance has continued year to date, but the team do appear to be cautious, as indicated by their running a decent cash position on the balance sheet, which I'm sure we'll come to later. But before I hand it over to Paul, a small amount of housekeeping. We've got around 30 minutes for the formal presentation and 15 minutes for questions. You're all muted, but you can ask questions by using the Q&A function, which you should be able to see at the bottom right-hand side of your screen. I'll put your questions to the managers the best I'm able. There are quite a number of people attending this session, so we'll try and get through as many as we can. But if we don't, we will try and answer those questions or get the managers to answer those questions and send those answers back to you by email. But without further ado, here is Paul.
Thank you very much, Billy, and good morning, everybody. Billy, if we could start with slide 2, please. So Billy's going to have to control the slides for me due to some IT issues on my side. So I thought we would start with just an overview of healthcare investing, our approach to that, and then a few thoughts on the current situation, and of course, the inevitable consequences of the pandemic, which is something that investors cannot get very far away from at the moment. So let's start with the outlook for healthcare. So this is indisputably the secular growth story of our age. You can see on the slide in front of you on the left-hand side, there will be ever more people, and those people will be ever older. And you can see on the right-hand side that healthcare expenditure correlates very strongly with age. So the outlook from a demand point of view for healthcare is relentlessly positive as far into the future as anyone can care to model. And you can't really say that about many other sectors of the economy with such confidence. If we could move to slide 3, in addition to those demographic population level drivers, we have wealth drivers as well. So once you've taken care of your basic needs, you have the opportunity to think about staying well. And so what you see is a very significant correlation between developed economy status and healthcare expenditure as a proportion of GDP, such that as you become an advanced economy, you see disproportionate growth in the amount of GDP that goes toward healthcare. And the world is getting ever richer, and there are more and more countries joining the club of middle and advanced economy status, which is another fillip to that already extremely strong demographic underpinning on the demand side. Now, all of that is fantastic and wonderful, but it does pose some significant challenges for society, which we'll come to in a minute. If we can move to slide 4, please. So you can see some of the challenges here. So the first thing about healthcare demand is it's uncorrelated with the economy. It doesn't really matter if there's a recession or in the middle of a boom, people get sick and they need help. So you have what's called a classic defensive growth sector. Now, the challenge of the demographic trends that I highlighted as such positives on the previous slides is that someone in the end has to pay for all of this. And if you go all around the world at any of the advanced economies, the UK is no exception to this, and you look at healthcare costs as a proportion of GDP and healthcare inflation, what you'll find is healthcare inflation exceeds GDP inflation pretty much every year, and if we don't change, it's set to forecast to do so moving forward. Now, that really presents us with a significant challenge. We have almost 3 options on the table. So the first is we can carry on as we are, and healthcare cost expenditure will eat all of our marginal wealth creation as society continues to age and grow, and none of us will be any better off than we are today. The second option, which in some ways is what we've done in the UK to a degree, is we could choose to restrict the growth in healthcare cost such that it matches the overall inflation in GDP. And what that means is you end up with a chronically under-resourced system, and you've really seen that play out quite strongly here in the UK during the pandemic, and indeed every winter, where you see the demand pressures that we face on the NHS. And the third option is to look at the whole thing and say, this doesn't work, we need to do something fundamentally different. The classic Einstein thing of doing the same thing over and over again and expecting a different result is madness. If we can turn to slide 5, please. So how did we get into the situation that we're in? Well, this is something that was painfully obvious for many decades, but like many things, was not planned for by politicians all around the world, because they are generally self-serving and very short-term in their outlook. But it's really a consequence of human evolution. So if you think about us from an evolutionary standpoint, human evolution stops at the age of the female menopause, which we can call roughly 50 years old. So any benefits that convey health beyond that age, you can't select for, you can't pass on through the gene pool, because you can't reproduce. So that there's no selection pressure there. So what we find, and as someone in my late 40s, I can attest to this personally, is you get to middle age and things start wearing out. And so if we look at the chart on slide 5, what you can see here is that when you get to the age of 65, which is of course the age at which you're no longer economically productive, generally speaking, but you are nonetheless still expected to live for many decades, 80% of the population have at least one chronic medical condition. And a chronic medical condition is something that cannot be cured. It has to be managed for the rest of the patient's life. So this is high cholesterol, high blood pressure, osteoporosis, type 2 diabetes, these sorts of things. And so you can see with these very straight lines here that we were always going to get to a tipping point as the population aged, when the balance between the people working and the retired people got to a certain point, that healthcare cost inflation was going to spiral out of control. And that is kind of where we are. Now, this may seem like a somewhat depressing picture in that we face this inexorable demand trend that we have to pay for, and we're going to struggle to do so. But the great news is that actually the healthcare system isn't fit for purpose, but it can be reimagined and delivered in a completely different way. And you don't have to take my word for that as well. We can talk later about the NHS and its business plan, and how even that organisation sees actually that the world could be very different moving forward. And this view of the healthcare system is what fundamentally drives our investment process. So we are an unconstrained healthcare fund, so we can invest in all aspects of healthcare, but we view everything from the prism of healthcare being a cost problem and a demand problem that society urgently needs to solve. And that top-down view really colours how we think about healthcare. So if we can move to slide 6, you can see how we try to really implement this into an investment product. So it's an investment trust. The investment trust is the most flexible structure that a portfolio manager can use. We set out a number of objectives for our strategy when we launched it in 2016, which is essentially to create something that gives investors operationally geared exposure to the products and services that will lead the transformation of healthcare that we see as inevitable, and to focus on those to the exclusion of whatever constitutes the rest of the healthcare sector. So this is a concentrated portfolio approach, maximum of 35 companies. We completely ignore the benchmark. We don't really pay any attention at all to what healthcare as an industry grouping is composed of. We focus purely on those areas we think are vitally important to that transformation. We're agnostic to geographies. We are agnostic to market capitalisation, so we'll invest in small companies and big companies alike. We are really only focused on liquidity in regard to that, and we think the permanent capital vehicle, the investment trust structure, is the best way to do it. We've tried to build our investment trust in a way that is best in class. So we have an annual redemption option as a discount control mechanism. That's a once yearly opportunity to redeem all your funds. It's ungated, so you can redeem part or all of your holding, which is obviously a great way of keeping the trust's share price aligned with its NAV. And we've had a very tight correlation between NAV and share price over the lifetime of the product. We've also engaged a very skilled board, so we have we've always had two extremely eminent physicians on our board. One of them is one of the most senior executives in the NHS, and the other one is one of the world's leading oncologists. And we have two other board members who are former healthcare portfolio managers in their past life as well. So we have a much more discursive relationship with our board, and they're paid in shares, and those shares are locked up for a 3-year period. And then finally, we have a transparent and simple fee structure, no performance fees or anything like that. And our goal is simply to deliver double-digit returns and to beat the wider healthcare market. So if we can move to slide 7, please. This is in many ways the most important slide in this presentation. So this is a pictographical representation of the modern healthcare system. Now, hopefully everybody on the call today is sitting in that green box on the left-hand side, happy and well. But the reality is, inevitably, at some point, you will seek the services of the healthcare system. This will be a consequence of your inherited genetic characteristics. So we all have a degree of innate disease risk. There's nothing you can do about that. Then there's lifestyle factors, because of course none of us smoke, none of us drink. We only eat healthy foods and we exercise every day, and we follow all medical advice. And then of course there's sheer bad luck. You could go outside and you could get hit by a bus or something like that. So at a certain point of time, you will seek the services of the healthcare system. Now, for most people, we have what's called a tertiary healthcare system, and it begins with primary care, which is your GP. So you will go first to your GP, assuming, of course, you can actually get an appointment with your GP, virtual or otherwise. That's been a challenge, as you will know, for many, many years. And your conversation with your GP, bearing in mind most people have no medical experience, generally begins with the GP asking you, the person with no medical qualifications, what you think is wrong with you. And it starts from there in an initiative process. There may be some tests and diagnostics involved. Often they require you to go somewhere else to get those tests and wait weeks for the results. But eventually they will come up with a diagnosis and a treatment proposal. Now, in the vast majority of cases, that treatment program will be to make you go away and stop bothering your doctor. So it will treat your symptoms, and there will be very limited follow-up to make sure you're actually okay. And the treatment protocol also will rely on you to do stuff. And as we know, humans are infallible, so they will, of course, change their diet, they will do exercise, they will go to their physio appointments, they will take their pills every day, because that's what we all do, right? And the reality is, when you look at real-world healthcare outcomes, they're never as good as what you see in clinical studies, because human beings are fallible. So hopefully at the end of all of this, you will recover in some way. Now remember, the vast majority of human illness is chronic in nature rather than acute, so it cannot be cured, and the expectation is that you will manage the condition yourself. Inevitably that doesn't happen for everybody, and you end up with relapses and the whole process starts again. Now on this slide you can see there are 21 bullet points. Those 21 bullet points are all products, technologies or services that exist today, so there's no sort of Star Trek-like requirement for innovation here. These are things that are real, that have been shown to either improve the quality of care, lower the cost of care, or in many cases do both, and all of them are featured in our investment portfolio. So simply put, if you invest in BB Healthcare, we are providing you with operationally geared exposure to those bullet points on that slide, and that is what we are aiming to create, which is very, very different to the typical healthcare strategy, which would be invested in a particular part of medicine, so medical technology or biotechnology, whatever it might be, or is geographically focused, or is what we call a benchmark aware strategy, so it's investing in the typical makeup of the overall healthcare system from a market capitalization point of view, which of course is dominated by a bunch of large pharmaceutical companies. Now, if we shift over to slide 8, we've just given you a couple of illustrations of some of the companies that we've had in this portfolio since inception. Many of these are still in the portfolio, some of them no longer are, but we've just illustrated some of the thematics and how that translates into underlying holdings. Now, I think the important message for any retail investor out there is that to the extent that you do have healthcare exposure, it's probably biased toward those large cap pharmaceutical stocks, the likes of the GlaxoSmithKlines that don't really generate any shareholder value, pay you maybe a nice dividend clip, but the share price doesn't really do very much. And I think you'll all be aware that the kind of innovations that we're talking about are not going to come from companies like that. So if you're invested in those classical things, you will not be exposed to this inevitable change in the healthcare system. And hopefully the overwhelming message that comes from slide 8 is that you haven't heard of the majority of these companies, and that of course is exactly what specialist managers like us are for. So if we flip over to slide 9, why are we so interested in thinking about healthcare holistically from a top-down perspective as this structural challenge for society? Well, it's simply because the availability of all of these new technologies, products and services means that we can address things that we couldn't address before. And if you know anyone who works in the medical profession, you will know their constant frustration. So 1 in 4 medical appointments, be them hospital consults or GP consults in the UK, are deemed not medically necessary after they've taken place, which is obviously a bit late. Roughly speaking, 25 to 30% of all frontline care staff time is spent on paperwork. So, you go to medical school for 7 years and you end up filling in forms. This is not what we want people to be doing. It explains why we have all these challenges in scaling this model up. And these technologies, products and services that introduce efficiency and better decision making into the system for the patients and for the practitioners offer tremendous value creation. That's really what you can see on slide 9. So if you look on the top left, you can see Diversified Therapeutics. That is a classical drug company. That's where your Glaxos and your AstraZeneca sit. And you can see the revenue growth opportunities in the other parts of the marketplace. And on the right hand side, EBITDA, that's a proxy for cash generation within the company. So the sexy end of healthcare is very much away from the classical pharmaceutical companies that make up the vast majority of the benchmark and the vast majority of direct investment strategies in this sector for retail investors. And where you want to be is in healthcare IT, healthcare technology, diagnostics, these sorts of areas, specialist drug companies, where you're going to get much higher levels of growth, much higher levels of cash generation. All other factors being equal, the stock market over the long term is rational and it will reward the companies that generate those cash returns for investors over time. So how does this strategy translate into investment performance? If we can flip over to slide 10. Billy was kind enough to mention some of this at the beginning. You can see our returns versus our benchmark on the left-hand side, and you can see healthcare versus the wider marketplace on the right-hand side. Now, we have been in a very unusual market dynamic for several years now, but really that's been turbocharged by the COVID-19 pandemic. In that we're now in a market that is very technology-led. The leadership of that marketplace is incredibly narrow, dominated by a small number of household name technology stocks you'll be very, very familiar with. And you can see that's really what's driven the vast majority of market performance. And you can see on the right-hand side that healthcare has outperformed the wider MSCI World Index. And you can see that obviously the biggest component of that has been technology. So if we take the technology bubble out in many ways, then you can see the extent to which healthcare has significantly outperformed the overall stock market. And we would expect that to continue for the simple reason that we have these significant demographic, economically insensitive drivers of demand. But we cannot ignore the wider market. You as investors, you're focused on relative value, you're focused on risk diversification in your portfolio. So where does healthcare sit at a time of zero interest rates in the middle of a pandemic against record stock market valuations being reached month on month on a global basis? Well, if we flip to slide 11, we see a very interesting picture. And particularly there on the right-hand side, you can see exactly the impact of this surge in technology companies, which of course trade on very high PE multiples, and how that has in turn driven up the valuation of the overall market. So the market in a historical context is expensive. Whether or not that's relevant is an interesting question, because of course the dynamics of technology companies in terms of return on capital employed and marginal costs to gain additional customers are unprecedented in a historical context, so maybe those valuations are justifiable. I think the interesting thing for us is if you look at the S&P 500 healthcare, which is the lighter line on the right-hand side, what you can see is that healthcare is trading on a forward earnings multiple basis at a comparable level to where it's been for the last 4 or 5 years. So as the market has become more expensive in terms of buying growth for investors, that hasn't translated into healthcare. Healthcare is still, in absolute terms, reasonable value. And as a consequence of that, relative to the rest of the market, is extremely cheap, which you can see on the left-hand side. So notwithstanding any potential excitement you might have about the forthcoming end of the COVID-19 pandemic and the return to normality with everybody going on cruises and airlines and going to the pub and restaurants and cinemas and all these things, and wanting to get yourself some cyclical exposure to that consumer-led upswing and all that pent-up demand, you're actually paying a significantly lower value for growth in healthcare, and that growth is more dependable over the longer term because it's demographically driven, and it's not just a bonus of growth that's coming from a potential recovery. So that brings us neatly onto the subject of the recovery, and the macro and our thoughts on COVID. So let's start with the macro on slide 12. If you are investing in the stock market today, you are playing the reopening trade, whether you want to or not. There is a degree to which it is assumed that life is returning to normal. It's been a source of some consternation to us as healthcare professionals, the pace at which people thought this would happen, i.e. they thought it was going to happen too quickly. That's definitely been moderating over the last couple of months. I think there's a bit more rationality coming into expectations for normality. But still, the execution risk, as far as we're concerned from a healthcare point of view, is to the downside, and this will probably depress all of you. But if I had to think about what Christmas 2021 looks like, it looks a lot more like Christmas 2020 to my mind than Christmas 2019. So, we'll probably still be socially distancing, wearing face masks, and we may be subject to degrees of restrictions on our socialising and other things. And sadly, there will be more waves of COVID. What they look like is an interesting question. We can come to that in a second. But this is just something to maybe think about with regard to asset allocation. We are not quite out of the woods yet, and to go fully away from defensive sectors and go full on into the buy, cyclical exposure trend may be a little bit premature. So let's talk about COVID-19 for a second. If we can move over to slide 13. I'm a scientist. I'm a bit of a science geek. I love all this stuff, and it is unquestionable that one of the greatest achievements of humanity is the delivery of a vaccine to a completely novel pathogen inside of 12 months. It is an absolute tour de force of global collaboration and medical progress, and something we should all be tremendously proud of. And more by luck than judgment, the UK has done an incredibly good job in getting us through this as well. So we're in a fantastic situation right now. There was another vaccine approved in the US yesterday that's coming to us imminently, and there'll be another one by May, to the point where it looks to me like there will be an excess of vaccine doses in the US and in the UK by June. So in other words, we will have more than we can possibly use, and we can start obviously then giving that to other countries around the world. So we are in a great position, but this is not without challenges. The most principal of which is that all viruses mutate, and in the first wave of the pandemic, if you were this virus, life was pretty easy because nobody had been exposed to you before, nobody had any innate immunity to the virus, so you could spread through the population like wildfire. You move on a year, and roughly 15% of us have some sort of antibody response to this vaccine, and here in the UK, 20% of us have been vaccinated. So a third of the population is effectively immune to the original strain of COVID-19. So the random process of mutation that goes on with viruses, it means that the nature is going to select, it's going to prefer the strains that convey some ability to evade that that immune response, and that's exactly what we're seeing. You've heard a lot about the South African COVID-19 strain, for example, and the Kent strain, and you probably heard about the Liverpool strain, which is a version of the Kent strain that has the same mutations in it as the South African one. And we're in a situation where there are three principal mutations that have arisen spontaneously all around the world. So this isn't just a question of let's close the borders and we don't have to worry about this. These things will spontaneously arise in the UK, just as they did in Liverpool, and just as they did in Kent, and just as they did in South Africa and Brazil. It's just a question of how fast that happens. So once you get mutations at points 484, 501 and 417 in the spike protein of the virus, you have a problem, because it sort of halves the effectiveness of the antibodies that your body would have made if you'd been exposed to COVID-19 the first time around, or if you've had a vaccination. Now, it's too early to know whether or not people who get infected with these variants get seriously ill. What it does mean is that they do have the potential to get ill. The great thing about the vaccines that we've created, not only have we created them quickly, but their efficacy in preventing people getting sufficiently sick that they have to go to hospital or they end up dying is incredible. So if you look at the cohort of people who got the vaccine in clinical trials, which began in May, it's about 100%, as far as I'm aware, of no hospitalisations, no deaths. which is obviously as good as it gets. If we can turn COVID into something that means you have a bit of sniffly nose and need some Lemsip, then we don't need to worry about it anymore. But the risk is that the arrival of these variants, which was inevitable, as I say, means that we might not be able to vaccinate everybody before actually the strains have changed. Now, you might say, well, we have this issue with the flu, we vaccinate everybody against the flu every year with all the different strains, and that works really well. That is all true, but flu is a different virus to coronaviruses, and there are some reasons why you cannot just assume that giving somebody a vaccine to these new variants is going to work and is going to protect them in the manner that you'd expect. That is a very complicated discussion. So we'll leave that to one side, but it's something called the Hoskins effect, and we need to do a clinical trial against a vaccine for these variants, these triple mutation strains, to see whether or not it's going to work. Now, the great news is, once again, incredible innovation by the biomedical community. Moderna, who was the first company to put a COVID vaccine into clinical trials last year, have actually shipped a variant vaccine against the South African strain with the triple mutation. So they're going to start doing some clinical trials, and we will know the answer to this question within a few months. And then if the answer is it does work, we can start making these things. And given that we've got about a 6-month lead time on that, hopefully we can start vaccinating people with a booster against the variant before the end of the year. So in time for the Western world's sort of respiratory disease season, which begins November, December, and we can avoid a bolus of cases. So we're probably going to get more waves. The question is, are they going to be what we call silent waves? So you see loads of cases, but you don't see hospitalizations, you don't see deaths. If that's the case, nobody's going to mind. But we have got a bit of a challenge on our hands with regard to staying ahead of these variants. And you know, I want to be as optimistic as everybody else that this is going to work, but I'm a scientist, so fundamentally I need to see some data on that. If we flip over to slide 14, you can see exactly what's happening here in the UK. You know, very clearly, our vaccination drive, our prioritising of first doses, has worked incredibly well. We are driving down hospital admissions amongst the vulnerable population, which is exactly what we want. As I say, if we can turn this into effectively a silent disease, then that is brilliant, because it's the hospitalisations and the deaths that we need to worry about. So, in summary, then, slide 15, I think we are getting there, and I'm hopeful that by the end of the year we can be at a point where we can genuinely start to look beyond COVID-19 and think about the world as it was, and some degree of normalisation. But personally, I would be cautious about over-interpreting the freedoms you're likely to get between now and then, in terms of being able to go abroad or wanting to go abroad, in terms of, you know, us all getting to put our masks in the street and burn them or something like that. We're not going to have a big bang moment, I think, where all of a sudden life goes back to how it was in 2019, at least not in this year. And we have to remember as well that the rest of the world needs to be vaccinated, because otherwise these people are also going to be a reservoir of opportunities for the virus to further mutate and new variants, and then the cycle potentially begins all over again. So there is still some ground to cover, and that has obviously beyond the personal implications, that has investment implications at all. So let's bring that to a summary on slide 16. Hopefully I've not depressed all of you too much with my comments regarding COVID, but I think for us and our strategy, we continue to be in a sort of planning for the worst, hoping for the best mode. So we have been eschewing some areas of healthcare that we would normally want to be exposed to, like elective surgery, so minimally invasive procedures for non-urgent treatment. We completely disinvested from those, and we're not yet willing to go back in, because we see waiting lists continuing to get longer and hospitals continuing to prioritise emergency cases and leaving additional capacity aside for things like COVID. So I think you have to tread cautiously through the transition back towards a normal healthcare environment, as well as a normal overall environment. And we need to bear in mind as well that some areas of healthcare that people have got very excited about, some of the diagnostic things, some of the healthcare technology, some of the vaccine stocks, are trading at extremely high valuations that don't really make sense in a long-term context. So one needs to plot one's course to all of this very, very carefully. And I think, as I say, if you look at the market in totality, the presumption is all of this is going to go swimmingly well, and therefore, by definition, the risk is to the downside. So we think continue to have some exposure to healthcare and continue to cautiously assume a return to normality is the appropriate way to plan for the next sort of 6 to 12 months. And that was all I was going to say. Obviously happy to take any questions. So back to Billy. Thank you.
Hello everyone again. Thank you very much for that. I've got a few questions. Does the trust is very US focused, and there are a lot of world-class health companies in Europe and India and China. So maybe you could explain why you're so US focused, and is this likely to change in the future?
Sure. So by background, I'm a UK scientist, and I would love to tell you that we are the capital market of choice for healthcare companies, but sadly it isn't true. We are a huge innovation hub for life sciences in general, and Europe has many hotspots in that regard. Paris to some extent, Brussels, Edinburgh is as well. The problem is that historically, healthcare investors have been overly risk averse. So when it comes to funding biomedical developments, they tend to shy away from them simply because it's very expensive, it takes a long time, and it's very risky. So if you look at drugs, for example, the probability of a drug actually reaching the market and making a profit is about 4%. So when a drug goes into some kind of preclinical evaluation, you're talking about probably 10 years and up to $1 to $2 billion of costs involved in that process as well. So you can understand why a lot of people don't want to fund that. The US attitude to all of this is very different, and it's also very different from a regulatory point of view. So there is much more willingness to innovate and experiment in the US hospital systems, for example, than there is in places like the UK. So the US is the natural home of healthcare funding, and it's the natural home of clinical trials and risk taking. And as a consequence, if you get to dictate the rules of the game and you pay for it, you also get to dictate where things get listed. So the depth and experience in the capital markets in the US is greater. So we will be a US dominated strategy for the foreseeable future. We are aiming, and indeed have over the last month, increased our exposure to Asia. Asia is obviously demographically very important, but some of the challenges around due diligence and company structure in Asia are significant. In particular, they tend to prefer conglomerate business models, which is kind of antithetical to our operational gearing approach. So we're a lot more in the US than perhaps we would like to be right now, but I would say, assuming that we're going to stick around that sort of high 80s, 90% for the next couple of years is a very reasonable assumption. It's worth flagging as well in the context of this being a sterling vehicle. We don't hedge any of our currency exposure. We are healthcare people, we are not currency traders. So there is an inherent level of kind of dollar exposure that is unhedged if you invest in this product.
Thank you. Sorry, I was on mute. Thank you. Just a quick one. Do you invest in private companies, and at what stage do you invest in companies? I.e., do you consider ones that are still loss-making?
Sure, that's a great question. So we do not invest in private companies. We are very firmly of the view that public and private don't mix together. We have this annual redemption option. In order for people to believe in the annual redemption option that they can redeem on an ungated basis, they need to know that the portfolio is very liquid, and that is, again, antithetical to having any private holdings. So it's all main market listed equities, and we are subject to liquidity constraints that we agree with our board, and they're very high. So you should see this as a very, very liquid strategy. With regard to the level of maturity of the businesses we invest in, this is different to what you'd see in a biotech fund, for example. So because we're a high conviction concentrated portfolio overall healthcare fund, we're looking to balance risk across all the different parts of healthcare. So we want to have exposure to lots of different bits. And because it's a high conviction vehicle, we will not invest in things that haven't reached the proof of concept stage. So what that generally means is if it's a drug, it's probably been through phase 2 clinical trials, so we know whether or not it works, and we have a degree of understanding of its efficacy, so we can do some sort of pharmacoeconomic analysis of its benefit to society. If it's a medical product, generally speaking, it will be on the market, and you will be doing these sort of what we call outcome studies, where you will be at the point where you might be about to present, the real world benefits of this particular cardiovascular intervention or implant or whatever it might be. So we generally eschew early stage companies, and a lot of what we have that you call biotech, which we call focused therapeutics, is what we call platform companies. So they are technologies that have been developed that are amenable to many different medical interventions. The company's demonstrated more than once that it can develop a product that works in that way, and it's a question of it really exploiting that for multiple opportunities in the future.
Sorry. A few questions all sort of similarly related, which I think possibly relate to this chart here, which is and really try to get a handle possibly on what you see as exciting at the moment, which areas are most exciting, and obviously technology prices have gone up a lot. Is there a lot of opportunity in the sort of more technology orientated areas of the portfolio?
There are. There's some. When you get into the technology end of healthcare, it's funny. One of the things people talk about a lot in the technology sector is the Internet of Things and 5G. Now, I can't speak for anyone who's on this call, but I have zero interest in ever having a conversation with my fridge. I don't really know what my fridge is going to have to say to me or me to say to my fridge, right? But if you take this ability for things to talk to each other and you put it in a healthcare context, it gets incredibly exciting. So for example, if you have all of the call buttons in the beds in your hospital wired up to some kind of centralized system, and you can measure how long it is before the nurse turns up and switches the call button off, you can work out whether or not a particular ward is under or overstaffed, and you can move your staff around accordingly. You start putting passive sensors in beds, you can see if patients are being turned correctly or whatever, if they've got an injury that requires them to be in a particular prone position while they recover, or sensors that do they wet the bed, or any of these sorts of things. So there are lots and lots of really simple technological interventions that can transform the way we do healthcare. Now, if you think to any of you that spent some time in hospital recently, I was unfortunate enough to spend some time in a French hospital a couple of years ago, and they used to do ward rounds every 4 hours in the night, and they'd wake you up to ask you if you're okay. Now, funnily enough, the probability of the nurse turning up when you're about to have a cardiovascular event is pretty low. And if you were okay when you went in, I guarantee you after a couple of nights of that, you're definitely not okay because you haven't had any sleep. So the more we can do things passively and we can prevent human beings wasting time doing stuff they don't need to do, you can begin to transform the system. So a lot of what we call healthcare technology isn't, it's hidden, it's in the background, and it's productivity tools, and it's actually incredibly exciting. So we're very excited about those kind of, call them interesting things that sound small, but it's about those marginal gains. If you accumulate all those marginal gains, you can actually get some very big savings. The other thing that we've been really focused on since the beginning of the Trust Life, very overweight relative to any of our competitor funds or whatever, and has been a source of massive returns for us, is diagnostics. So the thing about diagnostics is that they have value in preventative medicine. The sort of apotheosis of this idea is what we call liquid biopsy, which is the notion that in the future you'll be able to get a blood test and it will tell you your global risk of cancer at that particular moment in time. And then if you do have some signals of early stage cancer, we can send you for a full body CT scan and we can find that tumour. Hopefully it's the size of the end of a ballpoint pen, and we can zap it with a radiation beam or cut it out, whatever, and you don't get these stage 3, stage 4 cancer diagnoses that unfortunately usually result in people receiving palliative care because the tumours spread too much at that point. So, but this whole trend of what we call point of care diagnostics, even the genetic elements, the technology is becoming ever cheaper and available in ever smaller boxes. And those boxes are gradually transitioning into the front line. So you'll see this in businesses, and you will have heard about this in schools, going out and buying diagnostic machines like Panther so they can do COVID testing on site. This is a simplistic example of that sort of thing. So the shift of sophisticated diagnostics from the centralized lab in the basement of a hospital somewhere to the point of care is incredibly powerful and transformational for the healthcare system. And personally, for me, that's one of the things that I get really, really excited about, because you can quantify the gains very, very easily.
Thank you. A few questions on, and hopefully not an opportunity to diss the competition, but how do you see this fitting in a portfolio, and also how does it fit within the other sort of, I suppose, investment trust competitors?
Sure. Well, I sort of hopefully touched on this a little bit earlier on. If you look across the universe of other healthcare funds, there really aren't any other that are thematic in the way ours is, from a top-down married to a bottom-up concentrated portfolio. So a typical fund is, 70, 80 positions, bigger sometimes, lower active share, so it looks more like the benchmark, and tends to be higher turnover. Ours is low turnover, very high active share. So our active share at the moment is 85%. I think it's the lowest it's ever been, which is pretty extraordinary. So it doesn't look like any of the other healthcare funds, and I think for that reason you could argue it's a complementary product. So clearly, there are funds doing early stage stuff like biotech funds and things like that, and there's services and medical devices funds. I think unless you're a reasonably sophisticated healthcare professional, buying a sector fund is probably a little bit challenging to understand the risk reward of exactly what you're doing. But amongst the general healthcare funds, I'm not going to say anything about anyone else's approach other than to say it's not like ours, so we would certainly see ours as being complementary to any holdings that anyone might have in any other open or closed-ended vehicle in this space.
Thank you. What's your average holding period?
Oh, that's an interesting question. So 40% of the portfolio is from inception. So what's that? That's 4.5 years. So we aim for sort of 3 to 5 years is what we've said. I mean, ideally longer, but that's what we're aiming for.
Can you confirm that the management team is invested in the trust?
Very much so.
Very English, not talking about numbers. Not British. There was one last one. Oh yeah, dividend policy. Could you please explain the dividend policy?
Yeah, sure. This is a very interesting topic. So, and it's always a good opportunity to bash GlaxoSmithKline, which is one of my personal favourite topics. One of the challenges with healthcare is a lot of people's exposure to healthcare is for income, in income portfolios. So Astra, Glaxo, amongst some of the highest yielders in the FTSE 100, especially now in the post-COVID era, where some of the financial companies have been prohibited from paying dividends. There is a problem, and the problem is this: innovation doesn't scale. There's loads and loads of evidence that shows this. Just because you're bigger and you spend more R&D dollars doesn't mean your productivity goes up. In fact, all of the academic research, which I've been involved in a lot of it, shows you that it actually goes the other way. And so what that means is if you pay out a large amount of your cash flow as a dividend, which GlaxoSmithKline does, for example, it pays out pretty much its entire operating free cash flow as a dividend, likewise AstraZeneca, it leaves you with scant additional capital to invest in biomedical companies with innovative ideas. And refreshing your portfolio of intelligent people is a key part of keeping an innovative culture in a large organisation. So you will see what the industry calls externalisation, so the buying in of new products and ideas, and accounts for about 25% of products for large pharma companies. If you don't have any spare cash flow, you can't do it, and you end up in the position that Glaxo's in, which is it can't invent its way out of a paper bag and hasn't been able to for the best part of a decade. So dividends are something you need to be very careful about. So we do not pay any attention to dividends when we choose to invest or not invest in companies. We are absolutely agnostic to organic yield, and because we're focused on growth companies in the US, actually the organic yield of our portfolio is incredibly low. Now, we do recognise that healthcare does play this outsized role in portfolio construction for people who require income. So we made the decision to pay income out of capital. So what we effectively do is we pay 3.5% of the net asset value of the trust at the end of the prior year out as a dividend in 2 equal instalments. Our internal hurdle rate for our investments is a teens annualised return. Our publicly stated objective is a double-digit return. We've actually achieved a high teens annualised return since the inception of the trust. So the way we think about it is we're effectively, if we achieve that teens hurdle, we're giving you 85% of that return in the form of capital increase and 15% in the form of dividend. And because most of it comes as a capital increase, that will obviously result in a progressive dividend policy, so the dividend will grow year on year, which indeed in our case it has. And that's what we do in terms of income. So you should consider the income to be paid entirely out of capital. We do offer a scrip dividend alternative for people who don't want to receive the income. But this was really our way of giving UK investors a genuine alternative to buying the Glaxos and the Smith & Nephews, which are very much at the low end of the innovation curve, and getting some exposure to these other things whilst preserving that income element.
Fantastic. Thank you so much, Paul. I think we've run out of time. It's now 11:45. So if you have asked any questions and they haven't been answered, we'll try and get them back to you. So thank you, Paul, and thank you everyone else for dialing in. The next session starting at midday, which is International Biotechnology Trust, which is in the same sector, but not quite the same, as Paul was explaining. Thank you so much again, and see you soon.
Bye-bye.
Thanks, Paul.